Let's take a look at where we are heading into this very surprisingly busy week. We have a jobs report coming up, obviously, on Friday, and what we're coming off on last week with inflation being a little bit elevated, expectations really kind of mired in a lot of geopolitical tensions, a lot of concerns around tariffs. VIX is at a 3-week high. We're at 18 right now, and this is kind of what we've been waiting for, this uptick in volatility to give us an opportunity to get some movement in some equities, get some movement in some stocks, and start to be a little bit more active. You see the safety trade really kicking in. Silver, 41.20. Long silver since 20. We were long gold from 2100 last March. And again, the continued debasement, the continued uncertainty, the broader geopolitical tensions taking gold higher. We talked about this on Friday, GDX, which is a backdoor trade for us when we're just selling spreads to the downside back under that 50-day moving average. Well, the very nice thing about a trade like that is that as it goes higher, the value of the spread that we sold goes down. We let time do its work. We're looking to take some gains on that, hopefully in the next week, week and a half, and just continue to allow that to happen. VIX again leading the day. WTI crude up higher on Russia concerns. Watching what's going on with silver, palladium, platinum, everything across the board. We are in an environment of strength for commodities, and now the weakness starting to appear in the equity side. Good morning. No debate. The ribs I made yesterday were rated the best ever by the Queen. No debate. I got nothing. You're good. You win. Good morning, Eric. Good to see you. All right, so we'll talk about momentum real quick. We'll get the runner at 9 o'clock, and given the fact that we did say over the weekend, you got to pay very close attention to what's going on with the semiconductor space. The SOXL has now dumped under its 200 and its 50-day moving average. Very important because this is where we could start to see some unwinding in those semiconductor stocks. We'll talk about the runner. We'll talk about what else lurks behind the shadows in the broader market. I spent the whole weekend writing, so I have a lot of opinions when it comes to what's happening in the broader macro environment. I did something that nobody should do. I read the BIS report, the annual report that they recently released, and I don't trust banks ever again. Anyway, why are you joining us? As you know, stocks are actually worth engaging in trading today. We'll break that down today in the runner. We'll look at some of our screeners, looking at the breakdown stocks, especially heading into this jobs report on Friday, where the smart money is positioning, of course. And again, those top screens, those top strategies of the day. It is a reminder that at 9:30, when you have days like this, as we start to see volatility creep up, you will become the exit liquidity if you're not paying attention. You'll see some sort of gap ups or gap down to start the days when volatility is elevated, and the market can and will turn around and go in the complete opposite direction. So preparation is 90% of trading as we move into September. All right. Good morning from Iceland. We got some people in Denmark. Very good to see. Wonderful. Thank you so much for joining us this morning. I hope the puffin is good. I enjoyed eating horse in Iceland. That's a whole story that I will tell. I'll tell it real quick. 4 of us went for a bachelor party in 2013, and we walked up and had dinner at around 11 o'clock, as apparently everybody does. It's like Argentina. And we're sitting there, and legitimately one of the most beautiful women I've ever seen walks up and takes our order. And my friends all order pasta and something else. And I said, "How's the horse?" And she looked at me and she said, "Only real men eat horse." And I turned to her and I said, "We'll take 4 horses." And then the night just kind of went a little insane after that. All right. So anyway, as we talk about this, looking at the Russell, we are green right now, but we have had weakening momentum going back to the last couple of days. And again, this is a measurement of stocks on a bell curve, stocks that are breaking out, stocks that are breaking down. Don, we needed a place to split in the middle. Some people were in Switzerland. Some people were on the other side of the world in Russia. We went with Iceland, and it was only 4 of us. Let it go. Let it go. What, do you go to Chicago? No, not doing that. Go to Vegas. No. Go to Iceland, eat horse, shoot a gun at a bird, have a good time. All right. 7 negative right now. So that means we flip over and look at the SOXL. That's problematic. And FNGD is now in focus. So We've seen this before. We had this happen last year. It was awesome. And we see a nice bump up on that 50-day moving average. We break above that 50-day on the FNGD. This is where I'm going to get a little bit worried. It doesn't mean that it's going to be long. I go back to what happened in September of last year. We had a huge move down in August of last year because of the Nikkei crash. This little pop right here was coordination on the Chinese, Japanese central banks with the US and the ECB involved. This is obviously the trade collapse. But when we get above that moving average, that's where we start to really slow down a little bit and start to think about, hey, do we maybe try to go the opposite direction and think about going to the short side? We're not there yet, but we may hit that point today. This is a very choppy environment. And again, the narrative has shifted as we move into September. You want to be very, very cautious. Now, the question is there something happening within the broader macroeconomic environment that could be problematic? The answer is yes. It's built around the U.S. debt. We are now being told, of course, within the news that there's a possibility that the United States might actually have to pay back all of its tariffs that is collected. Obviously, this is going to the Supreme Court, and most people believe that the United States has the authority, obviously, to engage in that type of commerce. But this was a major wrinkle, and this is a sign of one of the big debilitating elements of how we operate in the United States. Law can shut things down very quickly, whether you were opening a mine, whether you were engaging in tariffs and policy. Yes, checks and balances matter, but obviously checks and balances do have financial consequences. I'm not saying that as a negative. I'm just simply stating that if you are a trader and you're heading into the weekend and you have a position and you find out that all of a sudden that there may be some sort of legal case that's going to take 2 to 3 weeks, well, obviously that's going to impact positions. So that's why we kind of have to take a little bit of a step back, move into the intraday environment, or at least have more of a short-term outlook when it comes to markets, and kind of let this play out. I'm not going to be shocked if the S&P 500 actually turns negative before the Russell, and typically when that happens, fireworks can and will occur. This is what happened back in 2022 quite often. 5 times it occurred, and we are going to be very, very cautious in this environment. Gold is at a record high. Okay, so once again, as I've said, we're long gold, not because I like it, not because I think it's shiny, not because I think it's pretty, not because I want to wear it. I'm long because this is the debate, the ongoing argument that we're going to have to print more. We're going to have more debasement of the dollar. We're going to see more geopolitical uncertainty. We're seeing central banks around the globe continuing to step in and buy more gold. It's bullish, right? And whether it's an equity, however you want to look at it, whether you look at the oil markets or you look at the gold markets, you have to try to focus on where the positioning is at any given moment. So I was not a person who wanted to chase gold higher from all-time highs. What I have consistently argued is that when you look at the GDX, or you look at the GLD, or you look at something as simple as the FIZ, which is the Sprott Physical Gold ETF, I'm a buyer back at the 50-day moving average. I'm not chasing up here. So what do? I kind of change my strategy just a little bit, and instead I pick the price that I want to own it at. Well, I want to own the GDX at 55. So I don't have to buy at 64. I don't have to buy 100 shares and spend $6,435. I can sell one spread down here at the $55 level. And I can make 20, 30, 40 bucks just kind of playing the game and waiting it out. And if I do have to take delivery on it, good. If I don't have to take delivery on it, I pocket the premium on which I sold it for. Understanding and recognizing where you are in the technicals, we are overbought right now in gold, but it is an important reminder that just because we're overbought, these things can and will persist and remain overbought for longer than some people may anticipate. So if you're going to try to short this, and I have no argument against trying to short gold, say into late 2025, or on a different level, the fact that if we have some sort of liquidity event, everything goes. Gold will go down. Gold went down in October of last year. It went down during that crash that happened last year during the Nikkei crisis. No doubt about it, gold can and will go down. But my point is, if you're going to try to do this, go out further. Don't do it on a 1 week basis. Don't do it on a 2 week basis. Be patient if you have that conviction to try to ride something to the downside, and go out at least October, maybe into November. That way you have very tight stops. That way you are protected in case the trade goes the other way. Again, overall, long term, I remain very bullish on gold. My forecast again is 4,000 within the next 6 months, 7 months, and then I think we'll hit 4,500 by the end of 2026, and that is based on the fact that the liquidity cycle will peak around that point, assuming that it is not extended by the United States Treasury Department. Right now on the Russell, significant amounts of selling. We will see this, what happens at 9:30. Very important just to keep this in mind. Watch that 20-day moving average. We break under that, we're going to see an acceleration in selling. Companies like NEG, ARQQ, Tron, SMR, all under pressure. Today is really about the semis, though. SCMI is getting killed. Forgive me, SMCI is getting killed, super microcomputer. That's dropping lower. This is a short. Moderna, Coinbase, Palantir, AMAT, all of them are in focus as potential shorts today. Again, keep an eye on what's going on with the Fed rate cuts, 25 basis points, if not now 50. There could be significant weakness in the next 2 weeks. This is how narratives shift. Keep an eye on the GLD, GDX, TLT, IEF, and of course the dollar index. Futures are down a little bit. I broke this at 8 o'clock, so the futures might be down even more. I apologize. But again, payrolls, job openings, the non-farm payrolls are on Friday. Volatility is likely. Upside if data is dovish. Downside if the labor is strong. 75,000 jobs is the current prediction. Here's the problem. The bulk of the jobs in the United States going back 8 months are nursing, healthcare, effectively social workers. This is not a very bullish environment, and the concern is something can go sideways very, very quickly, especially if these job numbers are revised to the downside going back the last 7 to 8 months. Those are effectively proxy jobs for government. Very important to understand the distinction. In addition, there's problems going on in the UK. We have to pay very close attention to this. The 30-year gilt hit 5.7%. The UK, remember, caused a massive financial event 2.5 years ago. It was called the gilt crisis. Basically, what happened was all of these pension funds owned a lot of long-term bonds, and when they needed cash, they had to sell bonds. When lots of people sell bonds all at the same time, what happens is you have a crush on that on the value of those bonds. Yields spike. There aren't buyers. The UK Bank of England central bank may need to step in and start buying long-term duration relatively soon. The Guardian is worrying about financial stress, and I will remind you, no matter what you think about the Guardian was on top of the gilt crisis better than any other media outlet in the world. Well ahead of what happened. We have to keep an eye on this. I thought that the pressure was going to come from Japan. It seems that the UK is under even more duress than I had previously expected. Keep a very close eye on the British pound against the US dollar, the HYLD, and of course, Euro bond ETFs. We're going to get to the runner in a minute. Just let me finish up these last 3 points. They will provide a lot of value for you. Oil prices are climbing higher, and this is one of the challenges when you're trying to short oil, as I have been. Sometimes it doesn't work out because you spend a long weekend, you remain short, and something happens. Ukraine has attacks have cut 17% of Russia's refining capacity. This is significant. OPEC is going to make a decision this week. They're not expected to cut. In fact, they were supposed to hike their production. That may be off the table at this point. A lot of geopolitical tensions, a lot of weakness in the U.S. dollar. I admit when I'm wrong. I have gotten this wrong in the last week and a half, given the fact that the OILU was signaling that we were going to be going to the downside on oil. The OILU was dropping. Upstream kept moving higher. And I was very, very shocked by that because it's very rare that that happens. Usually when the OILU starts to break down, those companies go in another direction. However, I have said, again, we were right here when we started to move lower. I have said before, when you get into overbought positions, that's typically where there is a top. And the CTAs did not start dumping yet. So again, a lot of knowledge and a lot of insight into what's happened geopolitically. We have to keep a close eye on this. I think there is going to be weakness in oil. Again, I was just too early over the wall trying to make that prediction. On top of that, last thing, just want to point this out. Hedge funds are treading very lightly into September. We go through some of the data of last week. They were net sellers in August. They are very underweight equities. Very high retail leverage right now with concerns around rising bond yields. The implications are pretty simple. They have very fragile risk appetite, and there is a defensive bias heading into September. Watch the XLP, the XLV, the XLU, and the TLT. This is going to be a pretty much more wild September than I was anticipating. A couple of weeks ago, maybe 2 weeks ago, I was thinking, given the fact that we were not seeing, the historic volatility that we see in the last 2 weeks of August, that ongoing expansion and liquidity in September was going to provide effectively a historical anomaly where losses in September could be muted. But the way that momentum is moving this morning and the way that we are seeing a lot of selling right now in the semiconductor space, I'm raising the flag and I'm saying, hey, this is a yellow environment. We are starting to move into a risk-off environment. The hedge funds are leading the way on this. And this is where retail investors get to feast. And one of the last things I want to point out, as we head into this month, this is very troubling. Insider buying to selling ratio. Executives are not even bothering to touch their stock right now. In the 1 month, they are back to where we were at the June 2025 lows. And why does that matter? It matters because we are at levels that we only see not very often. This was the largest hedge fund sell-off that had happened back in 2022 in 15 years. And hedge funds barely touched their own stocks when that occurred. This is the environment. The geopolitical uncertainty is very, very intense. Executives are not willing to put their own money down and buy into this environment. We will continue to monitor this. Last time we saw significant insider buying was in April, obviously large buying in December. But right now, we are seeing selling levels, and in terms of that ratio, that we have only seen about 6 or 7 times, going all the way back to 2015. I hate to say it, it's very bearish, or at least it presents an opportunity for a more sideways market. As you move into this week, last thing, key dates: Thursday, private payrolls, job openings. This is going to be the most important job openings report I think I've ever read, and I think I've only read 3 of them. But the key thing here is, look, are they actually hiring? And we go back and we look at the EPI data. When we look at the current economic indicators and just kind of dig through some of these core things, again, looking back where we were, this is all about understanding whether or not this economy can sustain jobs. Are we going to actually start hiring people? And the reality is this has really, really slowed up. Econ Pi is what I was actually looking for. I apologize. This is a good representation of the current status of the U.S. economy at any given moment. All of the key leading and lagging indicators are put onto a quadrant. And as you can see, the mean of coordinates, which is the thing that really matters most, is starting to move into a contraction quad. The weighted is in the decline. The leading indicators still remain in expansion. But look over here. Hires, very low. Job openings, very low. Temporary employment, very low. Consumer sentiment, low. This is telling you that the average American consumer is in trouble. People are trying to find work. They can't find work. We're going to continue to look at this. Unemployment claims continuing to move into the decline quad. This is where the economy and the equity markets actually start to catch up. So we're going to start to see a lot more narrative in this next 2 to 3 months, particularly as we start to witness more of these things move out of expansion and decline. And that is where the pressure will be on the Federal Reserve. And that is why I continue to argue that they are too late. They should have cut. Non-farm payrolls, critical for Fed cuts. OPEC will be meeting this week, very important. And of course, Fed independence rhetoric could shift expectations. The Fed's not independent. I hate to break it to you. The BIS report said so. Last year, Japan, when their markets blew up, we had to respond. And a very simple comparison of what has happened with central banks in the United States. Imagine that you go and you set your heat today on your thermostat. You control your house, right? Well, imagine in about a month that your neighbor, their thermostat now impacts the heat in your house. That is what has happened post 2008. All of the central banks are intercoordinated through all of the hedge funds today. So a sneeze that happens in the UK can instantly become a financial pandemic globally. Now, this happened back with long-term capital management. It happened with the gilt crisis. It happened in 2011. But now you're starting to see the point where things happen and they happen instantly. 3-4 day flare-up that happens in a place like Japan or in the UK or in pick Switzerland, doesn't matter. All of these things are interconnected, and the United States has lost complete and total control of its monetary policy, according to the BIS, right? This is important because the BIS is the Bank for International Settlements. That's the central bank for all of the central banks, and it's in the report. And if you want to read it, we'll talk about it in a little bit. Stocks breaking down today. Let's talk the runner. We got time? Yeah, 9:07. Look, I'm 7 minutes late on this. You'll be fine. Alibaba breaking out. And once again, what does this all come back down to? Alibaba, which we discussed last week. And again, this is a Gianni stock. He loves those cyclical names in Japan right now. China is providing enough financial fiscal support right now to its consumer. It has held its rates in place. They are providing quantitative support to their economy. Very important. Alibaba continuing to move higher, looking for a continued breakout. But again, you might see some sort of chop along the way. I think a test back up around that 145 level is definitely in the cards. In addition to that, you have all of the energy names breaking out. NOG, if NOG can get above that 50-day moving average, looking for a retest of that 200-day. That's a $4 move. Look, I got it wrong. I didn't think the E&P place was going to be the place to be, but it's just continuing to run. And in this environment, you have to just play the key technical lines, and you're looking for NOG to continue its breakout if it can stay and break above that 50-day. Right now, acting as a little bit of resistance. Here's a stock I didn't know why it exists, but this is Children's Place. Children's Place. 20-day moving average is where you want to be paying attention to right now that we're back under that 50. If we bounce off that 20-day moving average, looking for either a move up or a move down, but that is your line in the sand for the next couple of days. And if we break under that 20 or break under that 50, break under that 20, you're going to the downside. Keep it short dated. Look into the 19th of September. And if we rebound and start to move higher, short dated, look into the 12th or the 19th as well. NVIDIA is obviously the biggest dog in the pack, and it is now in trouble. That 50-day moving average could act as resistance and support. Could be one of two things, right? It could support, or all of a sudden it can just flip lower and then suddenly become resistance if the breakdown continues. This is not about whether or not NVIDIA is a good company. It's not about the AI trade. This is now a geopolitical story. This is now about leverage. This is now about what's happening in the broader plumbing of the financial system. And if we're starting to see a hiccup, because if we see a hiccup, we have the type of move that we had in April. If we have a hiccup, we have the type of move that we had in August. NVIDIA is a leader when it comes to the issues that we have been talking about. And what we're going to be looking for in the next couple of days is some sort of coordinated support by the Treasury Department. If the Federal Reserve just lets it go, NVIDIA has a long way down to go, possibly down around that 140 level. But again, don't try to short this stock until we are under that key technical, because again, this is where the algos shut off and simply stop trying to buy the dip. And then we wait and we wait and we wait for the insiders to buy, and they're not buying right now. So Starting to get a little concerned about this. On top of that, CMRT Foot Locker. What a company. I don't know why this exists anymore. I remember, I think Spike Lee threw a shoe at somebody. I don't remember what those ads were about, but breaking into that 50-day moving average, and I think you've got potential weakness at least to retest that 200-day moving average. That takes you from 24, buying the 24 put, selling the 22, and looking for continued weakness in the consumer cyclical side. Let's just say you go out to the 19th on that. So buying the 24, selling the 22 for September 19th. There's an idea for you. On the momentum side, it remains the same. Metals, everything continues to climb. Silver now at 41.25. I'm not a person who advises people to chase things like this. I continue to argue, play the long-term game when it comes to these metals. Sell spreads to the downside under that 50-day moving average. Look for an opportunity to buy silver at a lower price. There will be corrections along the way. There will be downturns along the way. But you're starting to see the reaction and the breakout that a lot of people have been calling for at least 5 years. But nonetheless, I have remained very long silver for a long time. I'm not taking a victory lap because, again, as I've said, I held silver for an extraordinarily long time post-crisis. So I have held through, well, effectively all of this. So you don't get to crow when you watch silver dip the way it did. I was buying back in 2010. I started buying silver again back in 2017 when the Tax and Jobs Act changed. And then we've started to see this upward momentum. Momentum will likely remain strong, and I would not be shocked to see the SLV test at least 45 within the next 6 to 7 months. All right, final thing, breaking out, energy continuing to move higher. You look through the groups, you're going to see strength in the energy sides down a little bit on the day, but the last week, 1.2% move. Materials remain strong, commodities remain strong. Where's the real struggle? It's in the same three categories. When we have momentum breakdowns, and this is why I'm being very cautious right now, all three of these things go at the same time. Consumer service, communications, you got companies like Meta, you have technology, obviously, you know the Mag 7, and then you have the consumer cyclical. This includes Tesla, but it also includes what are the things that people buy? What is the discretionary spending? What's going to happen with companies like CCL, which are down 4% already today, and if CCL breaks under that 20, next test down to 28, next test down to 24. These things break down fast, as evidenced in previous market environments where we saw momentum break down. It is going to be a very long next 48 hours to see whether or not this is just kind of ongoing profit taking, or if there's something much deeper and more systemic in the current markets. BHF, Bright House Financial. What do you do? Well, hovering around that 20-day moving average, kind of a nothing burger at this moment. But again, this is a rate-sensitive insurer back over its 20-day. Strength on the RSI, MFI. I want to see that RSI above that 50 before I'm willing to bid. But the next move up is toward that $50 level. CRGY is back in play. Crescent Energy. This thing just keeps taunting me. But again, long-term small cap energy name. A lot of momentum on the backside of a recent merger. Looking for another retest soon at around 10:30. And finally, the NEXN. Cool. Next in international, what do you do? Communication services, advertising in Israel. The TASE has done very well in the last 2 years. And as we've seen, when this stock breaks above its 20 and its 50, it has had some pretty strong momentum moves going all the way back to last November. So this is one of those places where you can speculate just a little bit, buy the stock right at this level, set a tight stop at $10, and that's it. F score of 8, support at $10. Buy the stock, look to exit somewhere around $11.50 if you get there. Take profits along the way, maybe buy it, and then sell every 50 cents, exiting at $11.50 with the goal. It's 9:15. Taking a look at the chat room, making sure that we're on top of everything. You guys are still talking about Cheval. You're still talking about eating horse in Iceland. Well, Don's not. Don doesn't want to talk about that. Gianni knows. See, look, he's over and he's riding the horse on the beach, completely bareback, obviously, right? No saddle. probably just kicking that horse right in, and then that's what he does. Rides the horse in the morning, eats the horse at the night. That's the way to do it. All right. So, last thing, again, if you have questions about anything, support at TheoTrade.com. Put Garrett in the subject line. And as we look at current status things of affairs, I do want to bring up a couple of quick charts for you just to kind of show you where we are at any given moment. So as we sit here from yesterday, I put together a list of charts as I usually do on the weekends, and a few things that I just want to point out. A few simple things that I really want to point out because I think it's really important for people to understand and really go back to understanding how momentum works. So this is a really important chart right here. And it's a reminder that narratives will change very quickly, very quickly. It wasn't long ago that we were worried about the IWM. Now, we're going to be worried about the IWM again, but we saw that move off that 200-day moving average. And we have momentum readings that we talk about every single morning. We moved back positive on August 22nd. I filmed a video about it. This was right after Jerome Powell said in Jackson Hole that the Fed would focus on employment over inflation. And what happened? That was the strongest inflows. The second that reading went positive, it was the strongest inflows since the presidential election. So if our indicator goes negative, get out of the way. But if it goes positive, these are the times to have a lot of conviction and to be very, very bullish. Even if it's only a week and a half, that's the time to really buck the narrative and take aim at the opportunities. This is what I was talking about with the jobs market. You can see these are the jobs that have been added since December. 470,000 on the healthcare side and social assistance. But I mean, professional services, manufacturing, wholesale trade, this stuff is breaking down. It's very problematic. So we have to be very cautious in any environment about this because, again, you might see the top line number, but you have to dig deeper and really understand, are these government jobs? Are they government proxy jobs? Or are these things that actually create growth? And I hate to be that like kind of libertarian sounding economist, but the reality is we need to see growth here. We don't need to see more nurses. We don't need America to be just a giant hospital with an army. It doesn't work. It's not sustainable. And the more that we do this, the more pain there will be on the other side, which is great for traders and great for people who like volatility and people who like to short. But again, this is what creates that uncertainty. Gold did finally break out of this key channel. And again, as I've said, 3,500 currently. A nice move up to around 3,750 seems to be in the cards. I also want to point out this chart as well, which will also support the gold thesis, which is pretty simple, right? Central banks continue to hold more gold now than treasuries. I will go back and I will remind you, and this is why I continue to say we're at a pivotal time in the world. This is why you have to start to shift your expectations. You got to put your trader brain on, and you have to recognize that the next 12 to 18 months are going to be some of the most remarkable shifts in the history of the world, whether it's the geopolitical tensions that are going on, concerns around Russia, China, and India, or it's the impact on the US dollar, or it's just the fact that all of the things that we have come to know are shifting under our feet and people aren't paying attention. They're still acting as though this market operates on 1928 rules. They're still operating under the assumptions that things are based on valuations. And I argue this, if people want to believe that, let them, because I'm going to make a killing in the next 12 to 18 months because I see how all of this is shifting very, very quickly, which is why it's very important to put your trader brain on. Be with us at least 5 hours a day. We're live every day. We run from now 8:45 all the way to the close at 4 o'clock. I'm handling the last hour. This is very significant. The shift in gold, more gold than treasuries. It's signaling concerns around the US dollar. And I will note this, the biggest thing that nobody is talking about, and we have to go back and analyze, is historically that when we have big downturns in the financial market, the world turns to the dollar. That happened during COVID. It happened in '08. Everybody is trying to hoard dollars because it is the asset that all international debt is paid in. It didn't happen in April. And that's significant because it means that the reserve currency did not act as what the reserve currency is supposed to do. Huge change in what expectations are. I'll talk about what that means today at 3 o'clock. And I want one more chart, Don. I promise you this is the last one. Everyone who is an NVIDIA fan, I got to tell you, I made fun of this company a week and a half ago, and I was wrong. What has been the champion post-COVID? The number one stock post-COVID? Build-A-Bear Workshop. Fundamentals do matter at times. This company has had an extraordinarily strong F-score, strong Z-score, very cheap valuation, improving fundamentals for 5 years. It was $1 on April 1st, 2020. It just hit an all-time high recently at $70. Fundamentals do matter, but not at the S&P 500 level. We will dig deeper into the companies with the better financial metrics, and we'll show you where to rotate capital when it is time and the insiders start to buy. All right, 9:22, I got to jump. Don's coming up. He's going to throw some music on. If you are not a member, I don't know what you're doing because this is going to be an absolutely wild month. A lot of opportunity to make money. So let's get active. Let's get busy. Join us in the room starting in 8 minutes with Don. I'll be back at 3 o'clock for the last hour, and we'll continue to dig deeper and look for opportunities as the market presents them. Have a great day, everybody.